This week on Make Better Wealth Decisions, we're talking about mutual funds and ETFs with regard to the industry trends. What are the flows? What are the reasons behind it? What's going on in the US? What are we thinking about in terms of how the industry is likely to evolve in terms of the way advice is being given, whether or not you're getting a trailing commission or charging a fee, and how the industry might look going forward?
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGooley, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
My guest this week is Ian Tam. Ian is a CFA, and he's also a director of investment research for Morningstar here in Canada. Ian, welcome.
Thanks, John. Great to be here. Appreciate you having me.
Let's begin by talking. Maybe you could give us a quick 1-minute overview of what you do in your capacity as the director of research at Morningstar.
Sure, John. Yeah. So it's a bit of an interesting role, as the title says, director of investment research. Morningstar puts out a fire hose of research from all different teams across the world, all different asset classes, from private markets to public to debt. And it's a lot for the average retail investor to consume. And Morningstar has always held itself as a mechanism by which we empower investor success. So that means essentially, what can we do in terms of research or software or analytics that's going to help a person get to their retirement or whatever the financial goal is. And so being that we serve retail investors all the way up to pensions, a lot of that work has to do with trying to point the message to the right audience, right? So when we write a research report, very different when you read it from the eyes of a pension fund where you're doing asset liability management, as opposed to the everyday investor like you and I, who really just wants to buy a mutual fund or an ETF that's going to get them to retirement. And so my job is really to make sure that's all departmented and broadcasted to the right message. As a quick side note, I do sit on a couple of committees in Canada. I am on the Ontario Securities Commission Investor Advisory Panel, in line with Morningstar's mantra of helping investors. I'm also on the CFA Institute's ESG Technical Committee. So for those that are interested in sustainable investing or ESG, a lot's going on in that area. And so certainly some work to do to help decloud that area of investing for retail investors.
Perfect. I'm a big fan of the first committee, in particular, the Investor Advisory Panel. I think a lot more can and should be done, and thanks to people like you, is being done with regard to helping the general public work better with financial advisors so they get better, more professional, more transparent advice that isn't always part of what we're getting. And so I want to thank you for your work throughout the industry in general, but especially with the Investor Advisory Panel. I think that's really good work. You're working on the side of the angels. Let's begin by talking about laying the groundwork and understanding the lay of the land with regard to mutual funds and exchange traded funds. These are the two main vehicles that most retail investors use. And I'm wondering if you could perhaps just give us some background, very generic stuff about flows, innovations, that sort of thing.
Sure. Yeah, it's a big topic. Maybe to set the stage, the size of our market in Canada amongst those two instruments, so mutual funds and ETFs, it's about $2.6 trillion. And it's about 1/10 the size of the US market, just like our population. And so seeing as mutual funds have been around since really the 90s, a lot has changed. The biggest shift that we typically talk about is the transition over to passive management. So like many things in the financial industry, those trends tend to start in the US for the most part. And so an interesting, I guess, thing happened last year in the US that kind of puts things into perspective. So in March of 2023 last year, when you look at all the ETFs and mutual funds that are available in the US, for the first time, the split between actively managed, so where a human being is putting thought behind investment decisions, or passive, are those that follow an index or a rules-based approach to investing, which includes the smart beta products. That split between active and passive is 50-50. So 50% active, 50% passive in terms of assets. And that's an incredible feat. It was 20 years in the making, but slowly and surely, we finally saw those assets overtake. And so what that might mean for retail investors in the US is that, hey, they've woken up to the fact that maybe certain markets are quite efficient, and it's very difficult for a manager to outperform a benchmark after fees, importantly. And maybe they're better off just investing in an index fund. The other kind of evolution that we're seeing is that investors are still active, but they're expressing their active views through passive products. So you're seeing a lot more of these balanced fund or fund of fund structures that are investing in other ETFs. Of course, that counts towards their assets as well. So it's not that the other angle of that is that not that investors are becoming passive, it's just that they're using components to their overall asset allocation. So an active asset allocation that just happens to be passive.
So that I understand, so that when you have a supplier and there are 3 or 4 major suppliers, the big ones, especially in Canada, will put out an all-in-one single ticket solution where you can buy, say, a 60/40 portfolio or a 70/30 portfolio where 70% is in stocks, and that's diversified between Canada, US, international, emerging, what have you. And similarly in stocks, domestic, foreign, high yield, government, that sort of thing. And you're buying a 60/40 or a 70/30 basket, which in fact holds 8 or 9 different ETFs, which are balanced to meet a risk return profile and rebalanced on a regular basis, so that with one single ticket, you just buy that 60/40 solution or that 70/30 solution and you hold it, and everything else is done internally. And the all in cost is oftentimes going to be something like 20 or 25 basis points, whereas a series of active products with similar mandates might cost a full 1% or 100 basis points more. That's what you mean. I just want to make sure we're on the same page.
It is in part, yeah. We're on the same page there, John. Yeah, that all-in-one approach is a bit newer to the Canadian market. I was largely talking about the U.S. market to begin with, but yeah, you're absolutely right. That's certainly it's a great deal for the average retail investor, especially if you have a bit of technical know-how. You can open up perhaps a DIY investing account, buy that single ticker. You're not paying a ton in fees. Vanguard, clearly a leader in that space in Canada. Many have followed. And yeah, it's great for the everyday investor that does not have a very complicated financial situation and they're just plugging away towards retirement. I think that's a great deal. You're certainly not overpaying for active management fees, and you're going to do like the market does. That's what those products are intended to do. Where I was originally going towards, John, sorry if you don't mind, is that trend is going the kind of active passive split between 50/50 is pretty much there in the US. In Canada, we actually are quite different. Our investors, Canadian investors, for various reasons, tilt towards an active approach. So that same split between active and passive is about 85/15 in Canada. And a big chunk of that, roughly 79% of assets in this space, still sits within your traditional active mutual fund. And I think part of that has to do with the way our markets were structured. We're quite vertically integrated and you're a new investor, someone maybe new to Canada, new to investing, when they walk into a brick and mortar service kiosk at a branch, at a bank branch, so they're likely going to be provided with one of those types of products. And hence the active mutual fund structure in Canada is still quite strong. But like many things, if the US is a leading indicator of what's going to happen to our industry, I would suspect that we'll start to see this shifting in that direction. And even now, we're starting to see the beginnings of that. So we're starting to see fairly consistent outflows after the pandemic from mutual funds, and then that's being made up by inflows into ETFs. Our investors are getting younger. Many of them are opening up investment accounts before they even turn 18. And ETFs, of course, are quite easy to get in and out of in those platforms.
I must say that I'm disappointed that Canada is a laggard compared to other jurisdictions. 85/15 is, to my mind, even though the CAGR, the compound annual growth rate for ETF assets in Canada has been well over 20% since ETFs came out, 20 years ago or more. There's been a very rapid acceptance of ETFs, but a lot of that has been active ETFs. And the flip side of that is passive mutual funds. There are a lot of index funds available in the US, and there are beta replicating ETFs that track a benchmark, as you say, in Canada, but there aren't a lot of index funds in Canada. Can you explain why you think that is?
They're not zero. There are certainly some out there, and they tend to show up quite well in our rating systems, right? We tend to account for fees in our performance ratings. So certainly, having an index product makes sense to have a good rating. I think much of that, again, has to do with kind of the market structure. So when you think about how a commission-based advisor is compensated, typically, if you're able to recommend an actively managed, slightly higher cost product that's perhaps manufactured by the same firm that you work for, that's where your motivations are going to sit, right? I don't. It's not necessarily a bad thing. Many of these active mutual funds they perform quite well. Morningstar does have a view that the sale of a fund should really be decoupled from the advice that you're given. And many of these same advisors with a big enough account size can facilitate that. But unfortunately, for the small investor, choices are limited. So I think to answer, going back to your question, I think it really has to do with kind of the way our market is structured.
I think you're being almost too kind. So I'm gonna push back a little bit and say I do think it is a problem when advisors are recommending products that are active at the expense of things that are passive, and especially when advisors are using proprietary products at the expense of third-party products, because it calls into question the independence of the advisor and whether or not the advisor is in fact doing what's best for the client. Now, there are lots of ways that you can spin this and say, who's to say what's definitively unequivocally best? But the way I always like to tell the story is, what do you suppose would happen to these flows that we've been talking about since we started today if, in fact, passive products paid a trailing commission and active products did not? What would happen to what was being advised and what was being recommended? What do you suppose would happen?
That a rhetorical question, or is that a logical?
Well, it's intended a bit rhetorically, but I think it's good to have someone who's got expertise in the matter to go on the record with a substantive answer too.
Sure. Yeah. So I think I'm with you. I think the motivation of the advisor has a lot to do with where the assets sit today. I guess related to that, and perhaps what you're opining on, John, is the issue of titles. Title protection has been a recent topic of discussion amongst certain circles. And in Ontario, there was an attempt to create title protection for the advisors and planners. I think that kind of went a little sideways, to be frank
Mhm.
with you. It was
Mhm.
supposed to clarify very clearly, well, who is giving advice on in your best interest, and who is more of a salesperson for the product they're selling. I would draw parallels to going to see a medical professional, right? When I'm going to see a doctor, I want to, if someone has the word doctor in their name, I would expect that they have my best interest in their mind. Whereas if I'm going to see, I don't know, a pharmaceutical sales rep, they have a lot of knowledge as well, and that's fine. I would be happy to deal with them, but I need to know really that's where they're coming from. And so I think that's where the issue of title protection has really come into the limelight in the last 3 to 6 months, although it's been a much longer dated issue. And so to back to your point about proprietary product, like I said, I think many of these products perform quite reasonably when you
Mhm.
compare them against a broader product shelf. But that's not really that's not the point.
Right.
The point is to when you go into to talk to a quote unquote advisor, you need to know that they're selecting the best option for you and not just what happens to be available that they're selling that day. And I think hopefully my thoughts come across appropriately there.
So the way I like to portray that, Ian, is you should never have your business model drive the bus in terms of your product recommendations. And if people are recommending certain products because they pay a trailing commission at the expense of others that do not pay a trailing commission, then it calls into question whether or not the ones that don't pay a trailing commission might not, in fact, be better, but we'll never know because the person who has a business model that only uses trailing commission will only use products that use a trailing commission. And that actually brings up another point that I want to also talk a little bit about titles, because titles doesn't necessarily do anything to address the problem that I just mentioned a moment ago. And a lot of what is interesting is in the wealth management industry is that it uses nomenclature that seems innocuous, but in fact, it's quite potentially misleading. So let's talk about trailers. If you ask a person what a sales rep is or how to define a sales rep, they'll say, "What's the person who earns commissions?" And if you ask someone, and how does one define a professional, a doctor, dentist, lawyer, accountant? They'll say, well, that's a person who has a specialized knowledge and who works for a fee. What I find interesting is that trailers, whenever you read a prospectus or a fund fax or a formal submission to a regulator, will be referred to as a commission. But whenever the industry talks about trailers amongst itself, two different reps and what have you, they'll refer to trailers as a fee. And what's interesting is that legally they're commissions, and you can look up the definition in a dictionary. Trailers are clearly commissions, but the industry refers to them as fees because a lot of advisors are sales reps that are masquerading as professionals. And if you can't show it through the advice you give or the things you do, well, then just go around and call your commission a fee, and presto changeo, a sales rep becomes a professional. And it's really just a question of a sleight of hand that is used by the industry frequently. And I don't really see a lot being done to change that. And I don't see title protection having anything to do with that whatsoever. It allows it to persist for as long as you want.
I think where I might opine for a moment is where I think it does help is if you're talking to someone who's either the job description or they're forced or whatever to sell a commission-based product. If their title is salesperson, it
Right.
really spills into a very appropriate conversation. See, so I know who I'm talking to. If I'm talking to Mr. or Mrs. Salesperson, I understand that relationship. Whereas when you use the word advisor, that becomes a little quite gray and to your point, misleading if it is intends to be around your long-term financial goals. So that can be a problem.
So we agree. I guess all I'm saying is all I have seen thus far with regard to title protection as to who can call themselves an advisor, but I haven't heard much yet, and maybe I've been out of the loop about it being mandated that you have to call yourself a sales representative if, for instance, you only get paid via trailing commissions. I don't know if the business model is going to be part of what the actual title determination will be, but it seems to me that would be a very easy way of keeping score and being fairly, dispassionate and unambiguous.
I agree. And I think there is some work being done. I think that publicly in the Ontario Securities Commission's statement of priorities, I think in November of last year, there was a pretty bold statement around this. It's basically said that if you're being compensated by commission, we're going to call you out for what you're doing. You're a salesperson. We're not saying there's anything wrong with that business
Right.
model. It's
Right.
perfectly fine. Just call it what it is. And that was
We
a
agree.
pretty, in my opinion, quite a blatant kind of statement on the OSC's publication.
Perfect. So we agree. There's nothing wrong. Sales is an honorable professional pursuit. Lots of great people are very knowledgeable and very helpful as sales reps. They help people make better decisions. They're just not necessarily professionals and they just shouldn't hold out as such. I was asking you before we began taping whether or not you were familiar with a paper that came out a while back, about a month and a half or 2 months ago, by a guy by Cliff Asness in the US from AQR, which is called The Less Efficient Market Hypothesis. And I don't think you're familiar with it. So I wanted to maybe take a moment to talk about the paper and get you to weigh in terms of your impression. Again, accepting that you are not particularly familiar with it. So Cliff is a disciple of Gene Fama's. He runs a multi-billion-dollar firm called AQR, quantitative and a lot of factor-based. And we'll be talking about factor investing in a moment. So hold that thought. But Cliff's paper says that in his view, even though markets are highly efficient and have been for some time, that it's entirely possible that over the past 25 or 30 years, with a lot of noise trading and GameStop and Robinhood and whatnot, that the market has actually become less efficient because these things allow bubbles, A, allow bubbles to form, and B, allow bubbles to persist longer than they otherwise might, because a lot of what's being done is noise trading and emotional trading as opposed to evidence-based efficiencies of self-interested actors that are going to find ways to optimize and root out any kind of mispricing that might otherwise exist. Just curious what your impression of that kind of, it's a paper that caused a bit of a stir because, not the least of which, because the author is a very much an EMH disciple, very much a person who believes in market efficiency. And I'm wondering, and it's very difficult to prove. There's no real counterfactual, as there's very difficult to prove or disprove the efficient market hypothesis. It's just one of those things that's there. And there are people who agree and those who disagree. But it's very difficult to bring forward any kind of smoking gun evidence to prove it unequivocally. What are your thoughts?
I don't think I'll have any evidence on this podcast either, but I guess there's two sides of the coin on that. One, I think it's around the topic of concentration, right? As Magnificent Seven continued to really prop up the major US benchmark. I think the argument towards efficiency is that though the index is concentrated, these companies are producing significant earnings. They're contributing significantly to US GDP, let's call it. And so if a market index is there to mimic or to showcase the full US economy, I would argue that because they're concentrated doesn't make it's not a bad thing. They are pulling more than their weight in terms of production. They are producing positive earnings and sometimes substantial earnings. That would be different if it was not like a Brex or the .com type situation where none of these companies are producing any earnings. That's very different. When you look at NVIDIA, when you look at Meta, these companies are quite profitable in some ways. You can argue about the valuation, of course, but the bottom line is they're producing earnings. So that's one element of it. The counter to that is, yeah, the concentration misrepresents a few companies out of a much broader index. So yeah, I don't have the proof one way or the other. I think for the everyday investor, indexing against these broad benchmarks is still a very solid choice. And we're not here to change necessarily the trajectory of the market. We just need to make sure we get to retirement. And I think not too much to think about for a retail investor, in my opinion.
Okay, that's fair. As I say, I didn't really expect I don't know that anybody's going to have a big aha moment about this. It's one of those things that it's an interesting debate within the industry, and I'm just curious what your impressions might be. Let's move on to factor investing. And a lot of people listening to this podcast will be at least somewhat familiar with it, which is because it's actually very much part of what Gene Fama has done with his research partner, Ken French, and the 3-factor and now the 5-factor model. And you're looking at finding ways to maybe be what might be called enhanced indexing. And some people call it smart beta. I personally bristle at the word smart. I once heard someone say that smart is an acronym. It stands for a silly moniker about rules-based trading. But the idea is if markets are highly efficient, but there are certain things that have better risk return characteristics, then perhaps you can beat a benchmark by deliberately tilting your portfolio toward those securities that have certain attributes that will offer better risk adjusted returns. What are your thoughts about factor investing, and how is that catching on in Canada compared to the US?
Yeah, thanks, John. So like you, Morningstar is not necessarily a fan of the term smart beta. We call internally in most formal publications, we call them strategic beta products. And the reason we do that is because like you said, that you're taking an active bet using a largely passive approach. And so I think for the retail investor, the strength or the advantages of a strategic beta product is the same as the disadvantage. These are rules-based approaches. So if they're systematic in nature, there's no one really making a call on what stock to buy and what not to buy. So when a strategic beta strategy, or ETF call it, is value tilted, it will always be value tilted. That is the nature. That is what's written in the investment objective. And so it doesn't matter if value stocks are tanking, like in the US they have been for the last decade, it's going to be a value play. And so if you picked the right factor, yes, of course, you're in it for better risk-adjusted returns. You're not paying the full active management fee, but you have the active tilt. However, it's very difficult for a retail investor, to understand what factors are in play at the moment, and moreover, what factors are going to be in favor for the next decade. Near impossible to guess. So in terms of that, I think it's the pros and the cons. You have to have a pretty solid take on what you think is going to be in favor to make that a call. Size of the market has grown in Canada. So I'm just looking at some data here. Over the last 3 years, this is September 21 with the following 3 years, assets grew in this space from just shy of 30 billion Canadian dollars to about 37.1 Canadian dollars over 3 years. So that's a substantial growth rate. We saw largely inflows for that time period. We saw a blip post-pandemic when interest rates suddenly spiked. But other than that, they'd be generally positive inflows. That's still like 37 billion is still a very small slice of that $2.6 trillion market, as you know. But they seem to be gaining popularity in the US as well. We've seen a similar trajectory in growth with, spread across a much larger number of products. On the supply side, ETF and mutual fund manufacturers seem to have cooled their jets quite a bit. So we saw the most, I guess, action, if you will, between 2014 and 2020, where we saw a huge influx of these new products come to market. And since the pandemic, there's been much less interest from the manufacturing side to produce this. And I think there could be a couple of reasons for that. Maybe it's starting to feel like there are too many factors, or there's only so many factors you can build a product off of. And so now you're starting to come up with creative combinations, which there are some innovative ideas there. But how many more of these can there be? So that's one element of it. And then maybe manufacturers might be waking up to the idea that the market hasn't grown quite as fast that they initially thought, which, like many ETF fads come in and out, cannabis, et cetera, et cetera. A couple of angles there.
It's been a fascinating conversation, but I'm mindful of time, and I know we have to finish this off. So the way I always like to finish things, Ian, is to ask people, this is a podcast called Make Better Wealth Decisions. If you could offer one bit of advice to help people make better wealth decisions, what would that be?
Yeah, great question, John. I might be repeating many of your other guests here, but I think it's important to hammer this point home. Investing is as a marathon. It's not a race. It shouldn't be that exciting to invest. So if you're looking for the next big idea, or if there's a certain theme that you want to tackle like cryptocurrencies or robotics or automation, to name a couple, you really want to take a step back. These themes tend to be exciting to talk about around the water cooler, but our data generally shows that, with the more thematic you get, the less likely that fund tends to survive over the long term. And when you have these funds shut down, that typically triggers a tax action on your account. So I think the word of advice for me really is just be boring, rebalance regularly, stick with your long only, appropriate asset allocation tied to the amount of risk that you need to take on at that point in time in your life. And just don't make it too exciting. Just stay the course. And I think we'll all do just fine.
That sounds wonderful. I actually like that advice. And yes, it's one of the things that I say frequently myself. So don't worry. I think we're very much aligned there. I want to thank you for your time today. It's been a real pleasure.
Thanks, John.
John DeGooey is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdegooey@designedsecurities.ca.